Hi Young Investors, this is James Fletcher, founder of Young Investor Society, and we just concluded a great Q&A session. For those of you who weren't able to make it, I'm going to do a recap right now and go over some of the questions that we covered and some of the main points. So welcome. First off, I want to make a couple announcements. So everyone knows that the stock pitch report is due on March 16th, so a week from Friday. So work over the weekends, and we're really excited to see your reports. And last day in March, March 30th, is due the presentation for the report, so the PowerPoint presentation. This year, as you know, is shaping up to be the biggest and most competitive year ever. We are expecting 10 to 12 schools, or 10 to 12 regional state winning teams within those competitions. So we have a number of states. We have countries in Malaysia, Hong Kong, overseas Hawaii as well. And then we have an online competition for all those that are not part of the school competition. We're excited to announce that the winning team from each of the state competitions will go on to New York City. So we're going to pay 2 nights of hotel room in New York City, downtown New York City, right by Wall Street. And there we're going to have, on May 3rd and 4th, we're going to have a great gala event for the winning teams and for all the kids in the New York area that want to come down and watch and participate. That Thursday night, we're going to have Justin Leverance, who is the legendary investor from Oppenheimer, running their emerging markets fund. He'll be the keynote speaker, and it looks like it's pending, but it looks like we're going to get Morgan Freeman, Academy Award actor, to be there to be our honoree and meet all the winning teams. So it'll just be amazing. And then Friday, that next day, we're going to have a couple of investment workshops in that morning. And then starting at 2 p.m., we're going to have the stock pitch competition finals. All the winning teams will compete, and then the winning team will get $1,000 cash. They'll get Apple AirPods. They'll get a trophy for their school, and it'll just be this fantastic event. So I hope that motivates everyone. I hope you're excited to compete, and those statewide winners we will then fly and house at New York City, and will be just an amazing weekend from all the winning teams from all over the world for Young Investor Society. So with that, why don't we kick it off and talk about how to prepare your stock pitch. So I'm going to give some tips and tricks, and I'm going to go through, we just had a webcast and got a number of questions, so I'm going to cover all the questions that we got from the kids. Okay, so to start off, I thought the feedback that I hear from you is you always like the stories. You like the stories, and so as many of you know, I manage a $1 billion equity fund based in Hong Kong, and I invest in stocks throughout Asia, throughout Latin America, throughout the developing country. And so I want to tell you a real life example, just in 3 to 5 minutes, of a stock pitch that I did a year ago, and this should give you kind of a good indicator of what we're looking for in terms of looking for an investment. So a year ago, actually it was a couple of years ago that we ran into the company, but a year ago we invested in them, was a company called Auto Home. So Auto Home is the name of the company. It's actually traded on the NASDAQ. The ticker is ATHM. For those of you that want to follow along on Yahoo Finance or Morningstar or Zacks Research, or however you're looking at financial statements, ATHM, you can follow along. So Auto Home, for those of you who have ever bought a car or ever researched a car, Auto Home is the internet portal, the leading automotive website in China. So if you're in the US, it's like a cars.com or an autotrader.com or an edmunds.com. If you're in other markets, there's usually a leading automotive portal. And what they do is that you have reviews, you have professionally written reviews but then they have a lot of forums, and so it's user-generated content, researching cars, forums on what model, what color, what dealer is the best to buy it from, and then you have all the listings of the different models when you go to buy a car. So we were interested in this business, and there were a couple things that caught our eye. So one was the economic moat. So we talk about moats, and which is basically a company's competitive advantage. When you're looking at a company like this, what the most likely moat is going to be a network effect, and many of you have followed the lessons, so you know what a network effect is. Basically, a network effect is the more people that are on a platform or building an ecosystem, the more valuable that platform becomes, and then the more people that want to be on that platform, and it becomes this self-fulfilling cycle where that platform becomes very valuable. So think Facebook. The more people that are on Facebook or Instagram, the more valuable that platform becomes, and that creates a network effect. And what you look for in a network effect is once you've crossed a certain threshold where you become the dominant portal, then you become much more valuable than the smaller portals, and it becomes very difficult for a newcomer to compete. So in AutoHome's case, what we looked for is we looked for traffic, website traffic, and we went in and we looked at AutoHome, and we found that they were getting about 85% of the automotive traffic in China, web traffic, searching for cars, researching cars, looking for listings. 85% of the time spent in China was on AutoHome's portal. So we were pretty confident that they had built a network effect. The second part that interested us was the growth. So we looked at a company, and China as an automotive market is growing fast. They per capita consumption of cars is much less than in the United States or in Europe. We also saw that what you would call the OEMs or the car manufacturers, like a BMW or a Toyota, were spending much less on advertising in China, and that as a portion of that advertising pie, online was very small. So for example, online advertising in China was about 15%, whereas in the US or developed markets, it was about 60% of their online budget was spent on, or ad budget was spent online. So we saw that online portion of advertising having big growth potential as car buyers buy more cars in China. So the first one, first we liked the moat, second we liked the growth, and then third, you always ask yourself, what do we see that was maybe different than others in the industry, or what do we see that the market didn't see? And here we did a proprietary survey of dealers, and when we surveyed dealers, we asked them, how many of your leads are coming from AutoHome? So how many of your customers that come in is coming from this AutoHome portal? And they would tell us consistently about 30 to 40%. So about 30 to 40% of the leads or cars bought in China were coming from AutoHome's portal. And then we asked, how much of your ad budget are you spending on AutoHome? And they would tell us between 5 and 8%. So AutoHome is creating 30 to 40% of their business, and they're only costing them 5 to 8% of their advertising expenses. Basically, AutoHome was a very valuable portal and a tool that was very necessary for car dealers and car manufacturers, and AutoHome had significant pricing power. So we thought that even if AutoHome doubled their prices that they were charging to dealers, that they would still be the best bang for your buck. And so we saw significant margin expansion potential. We also looked at global peers. So there was a portal in Australia called carsales.com. We looked at how that market evolved and matured, and what we saw is AutoHome was making about 30% profit margin So 30% of their sales after expenses came to their profits, which is a fantastic profit margin. And because it costs little capital expenditures or CapEx to invest in the business, their cash flow margin was about 30% as well. So just an amazing cash flow margin. We looked at peers in Australia or UK, autotrader.com in UK, and they were making upwards of 40 to 50% profit margins, which is unbelievable for business. And so what we saw is that there was significant room as Autohome increased their prices and grew, that these margins would expand and that profits would grow faster than revenues. So in a nutshell, that was the crux of the investment thesis. I wrote, this is internal, but I wrote an investment case, which you can see on Autohome. This is on January 17th, 2017. So a little over a year ago. The price of Autohome was $29.79. At the time, it was trading at a 20 times price to earnings ratio. So 20 times PE, and that was at a discount to global peers. So global peers were trading at 30 to 50 times PE because it's a fast-growing industry and they were making very high returns. And then if you grow the earnings, if you look ahead a couple of years after growing earnings, this PE ratio in 2020 was closer to 10 times PE ratio, which was very low. And so we saw an opportunity, we saw a disconnect with what we thought the value of the company was and what the market was pricing it at. So we bought the company, we put about $30 million worth of cash into Autohome. And if you're following along at home, you can see that as of today, which is March 8th, Autohome is at about $85 a share. So you've gone from $29 a share to $85 a share, and we've made a substantial amount of money. We used our target multiple of 25 times. And so what we did is we forecasted ahead earnings based on our assumptions here, our previous assumptions on growth and on margin potential. And then we put we multiplied that by 25 times. So that was the PE multiplier. We put that on at 2019 earnings, and we came up with a target price, which was similar to where the stock is trading today. And so that's, they don't always work out as nicely as that, but that's in a nutshell an investment case. You understand the business, you've done a little proprietary work, you understand what the market seems to be believing, you have something unique, you have an insight that you think is valuable and maybe others are missing, and in our case it was this dealership number that Autohome was creating so much more of the value for dealers than what they were pricing for. And then you put a reasonable multiple on it, a PE multiple, or you do a discounted cash flow analysis, and then you come up with a target price. And Warren Buffett talks about how he doesn't even look at the stock price until after he's gone through all of this work. And then he comes up with the value of a company, and in Autohome's case, let's say it was $80 a share. And then he goes and looks at the stock price and he says, wow, it's only trading at $29 a share. This has significant upside potential. So I hope you enjoyed that story. It's a real life story, and I hope that helps you in terms of looking through a stock. So with that, I'm going to cover a couple of the questions that we got on the webcast just this morning. So one of the questions was on valuation. So we had a couple questions on valuation, which I'll go through. And the first one was one of the students said, I'm struggling to understand the different valuation techniques. Okay, so the first thing, what I would say is to go to lesson 7 in module 2, the lesson called Intrinsic Value. Call it L7, Intrinsic Value. And here you'll see in this lesson that there's 2 different types of valuation techniques that we teach you. One is the relative valuation, and this is where you'll use a PE multiple analysis. So you can do PE, you can even do a price to sales ratio. But basically what you're saying is, here's the historical ratio that the company's traded at, here's what their peers trade at, and then you forecast a couple of years in the future, 3 years in the future, and then you put that multiplier, that ratio, on top of what you forecasted. So in Auto Home's case, we went through it and I used a 25 times target PE ratio, and that's what I thought the company was worth. How do I come up with that? We talk about it in the lesson that there's this is the art of investing. So when Buffett says that investing is a science and an art, this is the art of investing, where you're approximating what you think the value of a business is. And if this is a graph, and this is maybe a 10 times PE, and this is a 20 times, and this is a 30 times PE multiplier, on average, the S&P 500 over history has traded at about a 15 times PE multiple. That's about average. Anywhere from 15 to 20 times is about average. And so if you have a company that's maybe worse than average, they're growing less than the market, they have lower returns, it's a more volatile industry, then maybe you would give them like a 10 times PE multiple. If you have a company that is in a high growth phase, or like a Coca-Cola trades at 22 times PE multiple, not because it's growing fast, but because it earns very high returns and it's a very stable business with a wide moat around it. And so kind of the better you get here, the higher you would be willing to pay for it on a PE multiple. And then if you look at like companies like Amazon.com will trade at over 100 times PE multiple because the market believes that the growth is so fast in that business. So that's one way, and you can download a template and you can forecast earnings for that and then put a target multiple on that. The other way is a DCF. And if you go on YIS.org and look on the stock pitch competition, there's a template where you can download a Google Doc that has a template to create your own discounted cash flow analysis. Basically what this does is it takes the growth, or the cash flows, and the growth that they will have in these cash flows for future years, and then it discounts it all back to what the sum of these cash flows would be at today's dollars. So that's maybe a little complicated, but the value of any investment, so whether it's a stock investment or a real estate investment or any investment, is what I pay today, and then the value of it is how much I'm going to get in cash flows every year indefinitely into the future. And so what this does is it says, okay, at year 1, I'm going to get this much in free cash flow back to me as an investor. In year 2, I expect to get this much. Year 3, this much. And this is growing. And then we use a time value of money discounter. So money 100 years from now is not worth as much as money a year from now. And so that's discounted back. And usually that discount rate is 8%. or 10%, that you're discounting $100 5 years from now would be worth maybe $70 today. And so then it's going to sum up all those cash flows and give you an implied value, and then you divide that by the number of shares, and that would be your implied value per share. So those are the two different ways that you can get to an implied target price for a company. So I hope that helps as a starter. Next question we had is how do I value a tech company? So we had a student that said the peer average trades at 45 times PE ratio. So I look at my competitors and they're all trading at 40 to 60 times price to earnings ratio. So I'm going to use about 45 times price to earnings ratio as my target multiple, and that's how I'm going to come up with the value of the stock. And he said, what do you think of that? And I said, that's a good, reasonable approach. The question that you're going to get is, how do you justify a high multiple? So the judge, your judge is going to say, okay, I understand that the peers trade at this multiple, but that doesn't necessarily make it right. So that doesn't necessarily make it right. And so what they're going to say is the average PE multiple is 15 times. And so why should I pay 3 times as much? It's like going out to eat, and instead of paying $10 for a meal, someone's asking you, or $15 for a meal, someone's asking you to pay $45 for a meal. So how do you justify it? Is the food that good? Is the service that good? Are the portions that much bigger? How do you justify it? And so when you use a target multiple this high, you're going to have to justify it. And you can justify it by the growth is much higher. So maybe the market is growing 6% a year, and this company is growing 20% a year. And I think they can grow 20% a year for the next 5 or 10 years, and this is why. So you're going to need to prove that to the judge. The other thing is maybe the returns, or maybe the uniqueness of this business is so strong. Last year, our winner of the stock pitch competition did a drone company, and I think the idea was that the multiple that they used on a price to earnings was very high, but because they had a unique product, unique patents, and the market was in its infancy and has significant growth potential, that it justified paying a high multiple for the current earnings, because we knew that those earnings were going to grow fast. So I hope that kind of explains using a high PE multiple in a tech space. The other thing I would say is some companies, some tech companies, you would use price to sales as the ratio or as the multiplier, or others would use price to book. And you can read on our Stock Investing 101 or on Investopedia. Price to sales is basically going to give you the stock price relative to their sales per share. And so tech companies may trade as high as 10 times price to sales, which is a very high multiple. And you can look at the range of price to sales. This will go anywhere from 0.5 to 15 times. But a lot of venture investors or PE investors or tech investors will use a price to sales because companies may not be profitable at the current state. Price to book is another one. That's price to equity or price to book value per share that you can use as well. Okay, so I hope that helps on the tech sector a little. Let me see. The next question we got was, how do I value a small cap company? Well, the student said, can I pitch a small cap company? And what is the disadvantage if it doesn't have liquidity? So that's a great question. I invest in quite a few small cap companies, and so this is something we talk about every day in the workplace. So, you know, for the stock pitch competition, you're not actually buying the shares. Well, you may be, but for the stock pitch, you're not actually buying the shares. And you're not probably, unless you're very wealthy, buying millions and millions of dollars worth of shares, which is where it becomes more tricky when a company doesn't have the liquidity. Liquidity is basically how many shares on average trade per day. So some small companies don't have very many shares that trade, and so how do you buy that? And so oftentimes, what I would do, my answer was, if I was pitching a small cap company, and let's say the valuation of this small cap company was 10 times. So let's say it's a restaurant, but it's a small restaurant, and it's only trading at 10 times PE ratio. But then I look at other restaurants or other fast food companies, comparables, and I see that they're trading at 20 times. So I'll say, like, you know, Chipotle, McDonald's, you know, other restaurant chains are trading at 20 times PE ratio. So what multiple will I use? So what I would likely say is, you want to acknowledge to the judges that you understand that one of the reasons why this company is trading at a discount, or half the price, half the PE ratio, is because it is a small cap company with less liquidity. So what I would say is something like, the stock trades at 10 times PE ratio. The competitors trade at 20 times PE ratio. I think part of that is due to the small nature of the company and the less liquidity. What I use as a target multiple is I use 15 times as the PE multiple for this company, because I think it's going to grow, and I think more investors are going to invest in it, and so the liquidity will improve. And I also think a 50% discount to comparables is too much. So maybe I'll give a 20% liquidity discount or small cap discount, but you know, 50% to go from 20 to 10 is too much. So that's a good question on small cap companies. They will often trade at a discount, but on the other hand, they offer higher growth potential many times. And so you balance less liquidity, and maybe the financials are not as readily available, but you balance that with stronger growth potential. So that is a great question on small cap companies. We also had a question on a large cap company. So someone asked, does it make sense to focus on the biggest companies, and does that change how you would value that stock? So it's a great question. Let's use the example of a well-known company. Let's say Walmart. So Walmart is a company that's been around for decades. And so when you look at some companies like Autohome, for example, when you look at Autohome, it's at an infancy stage in China, and you gain a lot of value from looking at comparables or other similar companies in other markets or competitors in their same market. But when you're dealing with a big company with a lot of history, your greatest resource is probably the history of that company themselves, right? And so let's say we're doing Walmart, and let's use our PE chart of 10 times, 20 times, and 30 times. And Walmart has gone through a number of cycles, gone through a number of recessions and growth periods in the United States. And you know, let's say the chart looks like this. So we could say that Walmart, you know, trades at peak at maybe 30 times PE ratio, and then it trades at a low of you know, 10 times PE ratio. And this is starting in 1960, and this is going, you know, all the way to 2018. And so over the course of decades, there's kind of a pattern of when times are good, when they're growing fast, when investors are liking the strategy of Walmart, when the returns are higher, it'll trade at a higher multiple. When growth is slow, when investors are worried, when you're going through like 2008, like the global financial crisis, it would trade lower, right? And so you can use this history of Walmart to say, okay, I forecast the earnings ahead 3 years, and then I put a, let's say 20 times PE ratio on Walmart. And this is the historical average, or this is slightly below the historical average, because in the next 3 years, I think Walmart is going to be in a slower growth stage than the past, or something like that, for example. So you can use the historical data on Walmart, and a graph like this would look very good to judges and look very good on your stock pitch reports. So I hope that answers your question on if things change on a larger cap company. Let's see, next question, we had some questions on the DCF analysis. So the DCF template is on yis.org. I would download the template. We have some notes on the side. I would read the notes, and I would read lesson 7 on intrinsic value before you get started, as you dive in. DCF analysis, just so you know, discounted cash flows. If you tell anyone that's a university professor or a professional financial investor, they will fall out of their chair if you tell them that you've done a discounted cash flow. So this is pretty advanced material. Most college students, university students, only learn about discounted cash flows, senior year in college or even in their MBA program. And you're learning this as high school students, and this is just a fantastic skill, and it's kind of bragging rights that you can tell people that, yeah, I created a DCF on Apple, and I think the value is $200 a share of Apple. You're going to impress most financial people in the room. So this is a little more advanced material, so take it slow. But our template hopefully allows you to make a couple of key assumptions and forecast out the growth of cash flows in a business, and then discount it back to the present value. We talked about the DCF is the current value of future cash flows, discounted back to the current level. Shoot us a question if you're having a question on the DCF. You don't have to use a DCF in your target price. Oftentimes I will look at both methods just to kind of get a ballpark of is one telling me something that the other isn't. And but good luck, and shoot us any questions if you have questions with the DCF. With that, I think I will go through briefly the topics and kind of give you a couple pointers as you go through it. So here is our template. So download the template on the website. Company overview. What does the company do? Give the judges a snapshot of what they do, where their sales come from. Fill out the company statistics, and you can find this data on Yahoo Finance, Google Finance. The investment thesis is the key area. So when I'm a judge, this is the first area where I look. And the investment thesis is, what do you see that the market doesn't see? It's your conclusion. This is where you want to make it catchy. This is where you want to make it unique to your analysis. So what do I see as the value in the company that the market doesn't see? And we put a lot of weight on the investment thesis. Another tip on the investment thesis is use as much personal information as you can. So, last year we interviewed Mark Cuban, and what he said is, I would love to read a teenager's report on Snapchat or on new technologies, because they have unique experience within their group of friends, within their using habits, that I would want to see. So use friends. If you're doing McDonald's, go to McDonald's, interview a store manager there. Try and find something unique, a unique work that you've done that gives you an edge. So I would say that's one of the key things on investment thesis to really make it shine. These graphs on the side, you just double click and then you can fill them in. I'll go quickly through this. Industry analysis is the industry where they compete. Who do they compete with? What their market share is, and then competitive positioning. So read about lesson 4, what makes a good business. Read about the different moats and identify what the key moat of the business is. Revenue drivers. What's going to drive revenue of this company? What are the key aspects that we need to know? How much growth will it have? The market or the global GDP growth every year is about 3-4%. And so why will this company grow more than that? And so be able to explain why you think growth will be higher. Financial analysis, hopefully we made this really easy for you that you can double click on this data here and you can fill in your forecasts and your estimates. You can get the numbers from any of the online sources. Also, you can get the numbers from the company website in the investor relations section. And then valuation, which we answered a lot of questions on valuation. What do you use as your target PE multiple, or how do you arrive at your intrinsic value using a discounted cash flow model? You can double click on this table and this will allow you to easily put in a target multiple upside calculation. And then investment risks. So this was another thing we talked about, is investment risks is another section that the judges are going to scrutinize heavily. If the judges see a risk that you don't see, they're going to dock you for it. So you want to make sure you cover the main risks to investors and that you're aware of the risks, and this is why you feel that they're not that big of an issue. And so don't skip over a risk, even if you think it's not a risk. Write it down, because if it's not there and the judges think that it is a significant risk, they'll assume that you missed it and they will cost you points there. And then the last one is management and governance of the company. You can see here, in the Coca-Cola report, we have a historical graph of the stock chart of the company, and then a couple of the major milestones that happened along the way in terms of CEOs, acquisitions that the company did. Yeah, so I hope that is helpful. We've talked about this before, but an investment case is really your calling card to a job or an internship in the investment management or finance industry. So when I interview potential interns or analysts to hire, we look at where they went to school, we look at their GPA, but most of what we look at is everyone will send an investment report, and then we analyze it and see how good of an analyst they are and how well they understand the basics of investing. And as high school students, this is your calling card. We had a student. Last year, of our 5 winning teams, 2 of them got paid internships in investment management and private equity because of this stock pitch report that they had written. We had a student that was interviewing to be a server at a restaurant, and then wrote a stock pitch report on that company. So went through their financials and went through their key moats and went through their competitive advantage, and got the job at the restaurant because he had such a good understanding of the company that he was applying to work for. So this investment thesis, this investment case, it's a calling card for applications for college, for future jobs, and it opens many doors in the investment management industry. So I look forward to seeing everyone's reports as they come in next week. This is going to be an amazing year. If you have questions, if this seems intimidating Take it slow, don't worry. If it's your first year doing an investment case, then that's great. We had many people last year doing it for the first time, and they did their best on the stock pitch report. They presented it well, they presented it with passion, and then they took the feedback from the judges and continued to improve it. And we had some state winners that were doing it for their first time. So don't worry if this seems overwhelming. Take your time, go through the lesson plans, do your best on the investment case, and for all those winners of the states, I look forward to seeing you each in New York City on May 3rd and 4th. I'm going to be doing a investment workshop for you that Friday morning before the finals, and it should just be a tremendous, life-changing experience for us down on Wall Street. We're going to tour the Federal Reserve Bank. We're going to tour 9/11 Memorial. Just be an amazing weekend. So I hope to see you all there, and good luck on your stock pitch report.